Hey, my name is Eric, and today I'm going to teach you how to build an e-commerce startup financial model in Microsoft Excel. This is the type of model that venture capitalists would ask for before investing in a company, and this is also the type of model that a small company, in particular a tech company, would want to build to be able to plan out its operations before it starts. So, first things first. Let's talk about customer acquisition. So here's the setup. We're a brand new company, and what we do is we run a subscription business where if you subscribe to our service, you pay a price every month, and we deliver you in the mail a few bags of coffee. So we're a subscription business similar to a SaaS business, but we're not selling software, we're selling coffee, but same business model. So we just raised $3 million from a venture capital fund to start this business. And we're trying to plan out, okay, what is the best course of action? How do we do this? So let's start. First thing is first, let's lay out a timeline. A typical venture capital fund will want to see a plan for about 4 years out. So M1 is month 1, M2 month 2, and let's plan it out to 48 months, which is 4 years. Okay, so let's center these here and maybe do an underline. And if we go in this cell right here and we go to the View tab and we click Freeze Panes, anything above and to the left of the active cell will get frozen. So here you can see we go right, but we can always see, no matter where we go on the sheet, we can always see where we are, month 1, month 2, month 3. So, like all businesses, we have to start with how much money do we have to market. So we're going to start with advertising spend. Advertising spend. And let's say we want to start out with $5,000 a month. So, first things first is we need to label this in like a dark blue. That's pretty standard across the industry for assumptions. So if you have an assumption, maybe not this color, maybe a different blue, maybe something more like that. A nice bright dark blue. When you label something in a financial model and it's dark blue, it means that it's a hard-coded number, meaning you just typed it in. So there's no formula there, and anyone else who sees this financial model will know that they can change that and mess around with the model, whereas anything that's in black is going to be a formula. So let's build out we're going to have advertising spend, we'll have paid CAC. CAC stands for customer acquisition cost. That is the amount that we spend to bring one new customer into the business. So if we spend $100 and from that advertising we get 2 new customers, we would divide $100 by the 2 customers, and our acquisition cost is 100 divided by 2, $50. So this is something we're always looking at in digital marketing to make sure that we're spending the right amount to bring new customers in. So paid CAC. Let's say we start out at $35, and we'll move on to some other things in a second. But if we were a normal business, let's say we ramp this up over the first 12 months of 5,000, 7,500, 10,000. And we go out to month 12, maybe at let's say month 7, we start spending 15,000, 15,000, 15,000, 15,000, and in month 13, we just start increasing it every month by a certain percentage. So let's say that we increase it by 7.5% indefinitely. So I'm going to drag this all the way out to month 48 and copy it over, and you'll see that 7% increase every month for that period of time gets us to $200,000 a month at month 48. Okay, so there's our advertising spend. Then we'll talk about paid acquisition. So let's say that in the coffee industry or in food, we know that on Google and Facebook and whichever paid advertising mediums we're using, it's about $35 to acquire someone, or maybe a little less. And we assume in the beginning it'll be a little more but as we build a bigger email list and get more organic sales, we'll be able to get the paid customer acquisition cost down a little bit. So let's say we get it down to $20 over the first year, and then it's just $20 for each new customer we bring to the business. Okay, so these are two very core metrics. Next up, we will be trying to figure out, okay, these are our paid transactions. So let's say we have month 0. So these are the brand new buyers. And the reason I say month 0 is because we look at people who come into the business in their first month, and then what do they do in their second month, and what do they do in their third month, and fourth and fifth and sixth. That's typically those types of cohorts are how you think about subscription businesses. So month 0, all we have to do is take our advertising spend and divide it by the amount we spend to get each client. So we know that if we spend $5,000 and if the acquisition cost is $35, we'll have 143 clients. So we can drag this out, and then, okay, so let's say month 1 plus. So let's just say, we're just going to say, in the second month, so we acquire them in month 0, and then in their first month of being a business, some of them will stay and some of them will cancel. So the people who cancel are people who, what we say in venture capital, churn. So they churn off the business. So we have churn rates, and so the churn rates of the people who are in month 1 and forward, let's just make an assumption, is 15%. So of our clients, 15% of the clients cancel every month. And that'll just be how we do it. If we were to build a more complex financial model, we would actually plan month 1, month 2, month 3, month 4, and month 5, because a lot of times you see the churn rates actually change over the lifetime of a client. But because we're building something relatively simple today, we'll just assume it's 15% for all clients. So if in month 0 we have 143 new clients, if I write this formula here, 143 times 1 minus 15. So 1 minus 15% is 85%. That's how many people we'll have in the second month. And then in the third month, if you think about it, we'll have all the people from who are brand new clients from month 2, plus all the people who recurred in month 2. So all of our clients together times 1 minus the churn rate again. So we can just basically copy this formula over, knowing that we'll basically each month we will have a certain number of total orders, which will be a mix of new and recurring subscription clients. Okay, so from here we can just copy this all the way to the right. And this gives us the basis of what we need to build a real revenue model. So you see, we started with the marketing budget, some assumptions around how much it costs to pull in a new client, and then we were able to create a model that shows orders, new and recurring orders over time. Okay, let's start we can maybe call this the customer acquisition model. And let's start another tab. Okay, and maybe this next tab will be our monthly model. So let's first off, let's copy, Control C, this first row, make our lives easier. Let's freeze the panes here, freeze panes, and then maybe zoom in a little bit so we can see what we're doing. Okay, so this will be our income statement. An income statement is sometimes called a profit and loss statement. It's a synonym, they're the exact same thing. And so here we'll forecast the revenue and the expenses and all this stuff. So first let's start on a section called assumptions. Usually you want to organize all of your assumptions, which basically just means guesses, about your financial model in one place. And like I said before, you're going to put the things that you type in, which are our guesses, in blue. So we will have, first off, revenue assumptions. Okay. And what will we have? We'll have the AOV, average order value. That's how much on average people order. And so in this case, it's probably just the price of our product, which we'll say is $40 per month. People pay $40 and they get maybe a couple bags of coffee. Okay, average order value. What else do we need for revenue? Probably refunds. Some people will, they won't be happy. But remember, refunds will probably be a percentage of new orders of that first month. They'll order it online, they'll get it in person, they'll say, this isn't what I wanted. So we'll say percent of new order rev. So this is basically a cost. And so we're gonna put a percentage of our orders they're gonna refund. So in this case, we'll say, with the same blue, 5%. That's a number that is pretty typical for a business. Discounts, again, percent of new order rev. Typically, subscription businesses and all businesses, discounting is a great way to get people to buy. And so you want to use it, a lot because it's expensive to market on Facebook and Google, and sometimes a discount is actually a cheaper way to get people in the door. So let's say 10%. For all of these things. So for the revenue, now we'll be able to forecast the revenue. We have the amount of orders, we have the revenue, we have the refunds, and we have the discounts. Okay, what else will we need to do? Next, we will have COGS, cost of goods sold, assumptions. So those are our assumptions related to the costs of our product. So directly the coffee, the shipping, these kinds of things. So we will have the product cost. So that'll be, the coffee itself, basically. Then we'll have packaging, fulfillment, how do you spell that? Fulfillment expense. Let's see, customer service. We'll probably pay a third-party company to do customer service. Merchant fees. Merchant fees are the fees that the credit card company charges to process the credit card payments. So this will be a percentage of revenue. Let's see, this will all be a percentage of revenue. Every single thing here. So, okay, great. So the product cost, let's say, is 35% of revenue. So 35% of the revenue goes to buy the coffee. Packaging, let's say, is 10% of revenue. Fulfillment expense is, let's say we start at 8%. Customer service, let's say we start at 7%, and merchant fees is, at least in the United States, is basically always 3% no matter what. It can be a little bit less, but that'll be flat. And so certain things here will just be the same forever. So for the product cost, the packaging probably won't change. But certain things, as we get more scale, as we sell more orders, the price will probably will go down because they'll be able to process more things and they'll be able to make more money. So let's say that one of these things that goes down over time is the fulfillment expense. Maybe as we have some kind of volume-based pricing and we bring it from 6 to, if we hit some number of orders, we get it down to from 8% of revenue to 5% of revenue. Customer service is probably something similar. 7 and then 6 because they're going to have to put a lot of time in the beginning to kind of get everything organized, and then 5. Let's say this is 5 right here, and then maybe 4, and that's as good as we're going to get it. And the merchant fees, like we talked about, are always going to be about 3% of revenue, and we can't really do anything about that. So that's where we end at month 12, and let's forecast that all the way out to month 48, year 4. Okay, so now we have revenue, we have cost of goods sold, and then now let's talk about operating expenses. Operating expenses. Okay, operating expenses are things that are not directly product costs, like not packaging or product itself or shipping, but they're more general expenses like things like advertising and marketing, engineering, executives, administrative functions, and they're all of these larger expenses that sit below the gross profit margin, as we would say. So the first thing we're going to talk about is headcount. So let's say we have a team, we have marketing/sales team, we have merchandising, we have product people, product management, product creative, all this different stuff. We have technology, so these would be engineers and IT people, and then like executive and admin. So this would be, of course, your executives, but also people who do accounting and people who do, all of the other things related to this business. And then here, let's insert a column right here. Click insert. Let's make that a little more skinny. And let's say salary. So this is actually a kind of a trick for building a payroll model for a really small company, just in the kind of simplest way possible. And I'm just going to show you this trick right now. So let's say, let's put some color here so we can kind of, see where we're looking and put some small borders. Let's say the salary of the marketing and sales person on average is $140,000 a year. And let's say for merchandising, it's, I don't know, $80,000 a year. And product is maybe $125,000 a year. And then for technology, let's say 150, and the executives maybe are making 175. These are just random assumptions I'm just making up on the spot right now. And then, of course, you're going to have benefits. So these are things like healthcare and payroll taxes and 401k matching. And these are always, again, I'm talking about the US here, but about 25% of payroll. So however much someone makes, you add 25% to it. So in this scenario, we're just going to put in the number of people we have in each role. So let's say we start with, one marketing person, 0, 0, 0. Let's say we got one, IT person and one executive. We start with 3 people, and let's say our group is 3 people, and then in month 3, we have, maybe we hire another tech person to help build out our website or some part of our technology. And then in month 7, let's say we round out the team. So we have at least one of everyone, and then that's our team for a while. Maybe we have 2. Maybe we hire another administrative person, maybe someone in accounting or whatever it is. And by month 12, we have maybe, at this time, we also add another marketing person. I'm just trying to think, okay, what would make sense? Because the idea of these models is to think through something logical, so investors could look at it and say, okay, you have a plan, here's some money. It seems like you're not going to spend it all too fast, and you have a plan to grow your business and use the money well. Okay, so in M13, at this point, I'm just going to say, add one person to every role, like this, and then just same going forward. And I'm going to say once a year, we just add one person to every role. So you see, I basically just said add one here, and then in the next one, just keep it the same. And I can just copy this as a formula every year. So on month 24, or let's see here, what month was this? Month 13. Okay. So in month 24, we'll still have the same. Okay, so add one person and then keep it the same. So every once a year, we're just going to add one person to every department. Okay, great. What's next? We have our benefits. Let's make sure we copy this forward. And as you can see, we're making the assumptions really, really clear. So if we want to go back and say, oh, we actually need a variety of people in this one department, we're going to need more marketing people, we're going to need more of this, we're going to need more of that, or our customer service costs more, we just change the numbers around. So this is a nice sandbox for us. Let's see what else we might need. I think our other operating expenses, say other operating expenses. We can pull in our advertising spend, of course, from the other tab. If I want to go one tab to the left, I just hold Control and hit the page up button. There, so you can see how we do it without a mouse. Whoops. I want to press equal sign and then Control page up, and then just go find that number. Learning how to use Excel without the mouse is extremely valuable. It makes you really fast. I spent a long time learning how to do it, and it's really worth your time. I actually have a course that I'll put a link in a discount below for a course about how do you learn how to use Excel without a mouse. I have some other courses. I have another course about just learning the most important things for business Excel. So if you want to really expand your Excel skills, please take a look at those courses or just give me a like if this is helpful for you. Okay, so we'll pull our advertising spend, we'll copy it over. Okay, so then we'll have 202,000. You see that number, we recognize that number. Then we have, let's say, other marketing. So advertising are things like you pay for an ad, like you pay on Google, you pay on Facebook. But other marketing might be like agencies, PR agency, or like consultants who might be your Facebook consultants or your PR consultants and things like this. So let's say we're going to put in some assumptions here, but generally in the beginning you pay a lot of marketing agencies to get your business off the ground and have them do things that you don't know how to do for you. So let's just say it's $7,500 a month, and generally this won't increase too much because you'll build out your own marketing teams, but you'll still might have a specialist to do your buy Google ads for you or whatever it is. Then you'll have your technology expenses, like hardware, software, especially a lot of enterprise softwares. You'll probably have NetSuite, and you'll have Google and other different stuff, maybe AWS. So let's say we start out with 15, I don't know, maybe $5,000 a month, but we have this and we do that for 12 months, and then it goes up, and let's just say it goes to, I don't know, $15,000 a month forever after that. $15,000 a month. And then here's the one where you really sort of capture everything that you don't know. This is the I have no idea what's coming bucket. Percentage of revenue. It's just, you put in something that just says, look, I'm going to spend a bunch of money on a bunch of stuff. I don't know what I'm going to spend it on, but let's just say 10% of revenue forever is going to go to a bunch of stuff I don't know. So that's good to put in your model just to make sure that you've accounted for spending a lot of money and also not knowing the future. Okay, great. So let's name this monthly model. Now we're going to use our assumptions and we're going to actually build the model out up top. So we have our assumptions section, and that's down below. And now we're going to go up top, and let's make some space. And this is where we're going to build the model. So let's start with revenue. And again, this is a pretty typical model that you would see venture capitalists using or startups using. So this sort of layout is pretty standard. Revenue. So let's say first we have gross revenue. So gross revenue, we're going to take our average order value, basically the price, and we're going to multiply it by how many orders we have. So we're going to go to the customer acquisition model, look at our orders here, and multiply the price by the number of orders. Okay, great. And I'll format this at the end, but I just want to make sure the formulas are right. Now we'll have the discounts. Discounts and refunds, and we'll have net revenue. Okay, great. So first we'll have discounts. Discounts will not be applied to recurring orders. They're generally to get people to buy the first time and get on our subscription. So for discounts, we're going to take our price times our discount percent times just our new orders. So not total orders, just the new orders. So you have new orders times the price. So that's new order revenue times 10%. Okay, great. And I mean, actually probably what would make the most sense is just to put a negative sign here. So you see, okay, great. That's a negative number. And then refunds is going to be similar, except I can probably just put a reference in here. So I'll show you how to do that. So we're going to go back, and refunds are going to be on the first order almost 100% of the time. So we'll say, okay, first order, and we'll multiply that by the price, and we'll multiply that by the refund amount, and let's put a negative minus sign in front of that. Okay, and then we're going to put this underline basically under border, bottom border here, but if you'll see, I can do it without the mouse. If you hit Alt, it brings up your menu, so you can basically choose any of these different tabs. And then if you hit H, it brings you to the Home tab. Then you'll see right here, B brings up the borders, and if I hit O, you'll see bottom border, O. If I just hit the letter O, I've got a border. So it seems slow, but basically once you learn how to do it, and it ends up being extremely fast. So let's see here. Okay, great. So we've got some of this. We'll probably want to put an accounting format on that. So here, we'll do this. We'll take the zeros away. We'll do the same thing here. We'll take the zeros away. And okay, so that's our revenue here. Next, we'll have cost of goods sold. Okay. Product cost, packaging. We can just copy actually from down below. Product cost, packaging, blah, 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 whatever it is. And this stuff's pretty easy. We just multiply it by percentage of revenue. And let's look here. So we take revenue, and we're going to put a dollar sign right here in front of the 7. What does that do? It's called a cell reference. You lock the row. So watch this. We'll multiply this by the packaging cost here, 35%. And if I copy this down, you'll see that the row didn't move. If I copy to the right, it references column D instead of C. But if I copy it up and down, it always references row 7, C7, C7, C7. So you can lock the row, you can lock the column, you can lock the row and the column, but another skill to learn about so that you can build your models faster and basically copy things around faster. So total COGS, and okay, let's take a look at this here. Merchant fees, total COGS. I'll say, okay, 3,000. And now we have our gross profit. Gross profit. This is one of the most important numbers, of course. And this is our net revenue minus our cost of goods. And here we'll see our gross, let's just call it our gross margin. Gross margin. Same thing as gross profit. And in this case, we just want to see what percent of revenue is the gross margin. So when we sell something, what percentage of the thing we sell ends up actually being profit? And it's 37%. Okay, cool. Next we will look at the operating expenses. So operating expenses. So we have our personnel, and as you can see, we prepared all our assumptions, so this is pretty easy to build. So if we just copy, let's insert a couple rows here, and if we just copy our marketing and sales and benefits, we do this here. We can move benefits up 1 square. And in this case, what we do is we take the salary, and I'm going to hit F4. And when I hit F4, you see there's now a $sign before the B and before the 49. This locks the cell in place. Now, I hit the asterisk symbol and multiply it by 1. Sorry. First, I'm going to take this and I'm going to divide it by 12 months in a year. So now we have the monthly amount of the salary, and then multiply it by the number of people. And I will actually take away the row so you can see that I can copy this formula and it'll do all the work now that I have this one formula. Okay, so what did this just do? It took $140,000, divided it by 12 months, and multiplied it by one person. Let's see about the next one. I just copied the formula down, and you'll see that the salary went down one cell, and so did the reference to column C. So if I just copy this through the whole thing, you'll see that if I go over here, it looks like we're going to have to make these a little wider. Let's see, how wide do we need it? Okay, great. That's fine. You'll see that in this situation, for the technology, it references technology divided by 12 times 2 people. And it's just a $sign in front of column B. So this formula we can just copy across all 48 columns. And then benefits are going to be all of your payroll. So we can just add that up with a sum formula and then multiply it by the percent. So it's going to be 25% of all these costs. And then this will be total. You'll have your total personnel costs. Maybe we'll make that B just to, in bold, just to call it out. And then what we typically do is sometimes, usually the first and the last thing we'll put accounting format on where you can see the actual $sign. So here we might put a accounting format and then take the zeros away because the zeros are really not helpful. So you'll see that you can see the $sign on the 11,000 and on the 48,000. And that's just sort of typical across the industry, an easier way to make your models look clean and organized, because these models get pretty big. So actually formatting them nicely, I think some people waste their time doing it too much, but it's good to do a little bit at least. Okay, what's up next? And then our last section, we have other OpEx. Other OpEx. And OpEx just stands for operating expenses. So don't be concerned about that. Let's copy our categories from down below. We have all this stuff. Advertising spend, other OpEx, blah, blah, blah. So advertising spend, let's go grab that from down below, the 5,000. And we can just copy that and it'll grab everything else. So this one, and other OpEx, it's a percentage of revenue. So let's find our revenue. Where are you, revenue? Okay, here, asterisk, multiply it by 10%. So, and then we'll total it up. Total other OpEx. We'll make this bold. And actually what we can do here is we can just copy format painter. We can just paint this with the same, whoops. We can paint this with the same format because it's fast and easy. Okay, great. Other OpEx. So now we'll copy this across. And in terms of doing the math, that's about it. So now we'll just organize this a little bit so we can take a look at, you know, how much money the business is making and losing. So now let's look at our operating income. So that's our gross profit minus our operating expenses. Oh, and I forgot to copy this across up here. So let me just copy that over. Okay, great. Okay. So now let's look at let's total up our total OPEX. So we have total OPEX, and we'll total the personnel stuff with all the other stuff. And I think this is actually a good opportunity to put the top and double bottom border. I think this thing really helps you highlight the most important stuff. And the most important stuff is revenue, gross profit, operating profit. And so it's probably worth doing on all that stuff, just so that when you look at this number, you don't get, blinded by, when you look at the model, you don't get blinded by how many numbers you see. So you have your total OPEX, and then you have, let's insert maybe in one more row here, your operating income. So this, at the end of the day, is how much money you made after you paid for all your expenses. But it's before taxes. So you have gross profit minus operating expenses. So obviously this is a negative number. It's negative 64,000, and the percent of revenue is, let's see, negative, I don't even know what that is, 1,300%. But that's not really important. You're thinking down the line, you're going to need to make these investments up front to build the company, and you want to see, okay, in month 48, does it make a profit? Wow, it actually does. It turns a profit at month 45. So in this scenario, we might want to take another look at the business model, see if, okay, is it possible that we can get the packaging for 5% of revenue, or let's say 7% of revenue, and the products for 33% of revenue. A little bit better, and let's see if that helps us down the line, turn a better profit. Or maybe this is 30% of revenue. And this is why you build a financial model, to see if basically your idea can actually make money someday. And in this scenario, eventually it actually does make money. So at the end of year 4, it's making $1.9 million a month, and it's making $200 of profit a month as well, at a 12% profit margin. Okay, cool. So finally, we'll generally want to create like a roll-up sort of summary tab. So I'll call it income statement roll-up. And this is where you basically just take everything that we just did and you make it more consolidated. So an investor, or just maybe yourself, you can just look at it and understand, okay, we have, this much cash before we need to raise money again. And, here's our general gross profit and things like this. So here's kind of a setup for it. I'm going to set up the format, then I'll pause the video and fill it in so we can review together. But generally speaking, we can basically merge and center 4 quarters. So let's say this is 2022. I don't know when you're watching this video. And let's say we have Q1, Q2, Q3, and Q4. So we can do a little format, put these in the center, put some little boxes around them, and then we can have a full year total section. And so let's make this all bold, and we'll have the full year total. Okay, and then maybe we can just make these a little skinnier. So you see, we'll add up each quarter and we'll add up the full year, and then we'll put each year in a row here. So we'll have 4 years. So I'll just clean that up really quick. So I'll say this is 2023, 2024, and 2025. Okay, great. And then the basic things we're going to have on this page are gross revenue, net revenue, let's say I make that bold, cost of goods sold, then we have gross profit, again, bold because we think that's one of the most important metrics, gross margin percent, we'll make that italicized, And then we have our operating expenses, and sort of we'll have our main categories here that are the most important. So we'll have advertising, if I can spell it, personnel, and other OPEX. And then we'll have our total OPEX. And again, this will be bold, operating income. So we're not going to be recalculating anything. We're just going to be adding together stuff on the other tab so we can look at everything in a quick way and understand it. And then the one thing we will actually add to this tab, though, is we'll say our starting cash. So let's say we just raised money from venture capitalists, and they gave us, let's say like $3 million. And so they want to know, okay, with $3 million, how much can you grow the company? You know, what's your revenue going to be by the time the $3 million runs out, or can you even turn a profit? So we'll have our cash balance, and we'll calculate that each quarter as we turn a loss but grow the business to see, okay, how long is it's called your runway, how long you can last before you need more outside investors to come in and give you more cash. So we'll calculate the runway. So what I'm going to do right now is I'm going to pause the video. I'm going to fill in this information, and the way I fill it in I would just hit the equal sign and do sum, open parentheses, go to monthly model, and I would just sum 3 months, and every 3 months is considered 1 quarter of the year. So just do that, and then format it, take away the zeros. So I'm going to fill this whole thing in, and then we'll review here in just one moment. What are we looking at here, basically? So what we did was we totaled up everything, and just to do a quick sanity check, let's look at the last 12 months. First off, let's format this. View, freeze panes. So now if we go up and down, side to side, we can always see the time period as well as the category. So let's look at our last year, our last 12 months. It says we had $508,000 of operating profit. So if we go back to our monthly model, this is just to check to make sure that you totaled everything up right. So here's our operating profit, and if we look at 12 months, you can see here 508,419. Okay, so this means that everything is totaling up correctly. So what are we looking at here? First off, if we start with $3 million, each month we drain 190, 216, and we keep going, and by the end of the second year, we only have $250,000 left. And in the beginning of year 3 is when our cash balance goes negative. So basically that would mean was that we have 2 years of cash if these assumptions around our business are correct. So that's something good to know as you plan, because obviously fundraising takes a long time, and you want to know that well in advance. What else can we see? We can see that the gross profit margin is increasing over time. Our revenue is obviously increasing over time. And our operating income, we turn the biggest loss in year 2. So this is the year we're fighting to grow our revenue enough so that our gross profit is enough to cover our operating expenses. So you can see that in year 2, our gross profit is not able to cover our operating expenses. It's 1.4, and our operating expenses are 3.1 million. In year 3, our loss, we still are turning a loss, but you can see the difference between the gross profit and the operating expense is smaller. So we turn a $1.4 million loss, and in the 4th year, we actually end up starting a profit. So it seems to me that this business model is okay if we could convince some investors to give us some money and grow the business and go for it. Okay, I hope you enjoyed. If you did, or if you learned something, please hit the like button, subscribe, take a look at my discounted course links down below. I have one course about the 20% of Excel functions used for 80% of business. I have another course about learning how to use Excel mouse-free to increase your speed. I'm also working on a financial modeling course, so please take a look if you're interested. and thanks for your time.